Good morning, everyone, and welcome to the EXPO International 2025. I'm Despina Hiladaki, and I will be your host for the next 2 days here at the Speaker Hall. Now, I know how packed everyone's calendar is. You're here because you are serious about staying ahead, asking better questions, and connecting with the people who actually shape this space, not just talk about it. So let's open the day with a kind of perspective that truly sets the tone. Our first speaker is someone who understands the global financial system from both a policy and a market lens, a rare combination. As chairman of the Fiscal Council of Cyprus, he has a front-row seat to the economic forces shaping our region and a firm grasp on how these trends ripple across financial services, investment, and regulation. He's here to connect the dots between macroeconomics, policy, and the commercial reality many of us in this room are navigating in 2025. Please join me in giving a warm welcome to Michalis Persianis.
Having some digital issues here with the speech. I don't know what I'm going to say if I don't find it. I will be just a second. Here we go. Okay. So it's great to be with you today. It's a great honor opening what seems to me to be a fantastic lineup of speeches for the next couple of days. But it's a strange time. I mean, by the time I will finish this discussion, several important events will unfold. Decisions will be made on matters of war, monetary policy, world trade. Discussions will be completed between stakeholders and policymakers on matters of regulation, fiscal management, and investments. And by the time this entire conference is over, it is not unthinkable that developments will start maturing on issues like digital currencies, exchange rates, and crypto oversight. Some of these events we may hear about soon, some we will learn about in a few months or weeks, and some of them we will never know. So how do we discuss issues that are so deeply steeped in what Donald Rumsfeld called unknown unknowns? On the one hand, we have seen this before, all of it. We've seen tensions in the Middle East, in the Indian subcontinent, and rising oil, a US policy trying to counter currency appreciation, a European community in turmoil, Africa rife with war, tensions in the South China Sea, and markets in turmoil. On the other hand, this is an entirely new world. Even though we do have parallels for every one of these individual events, from Yugoslavia to Kashmir, the oil crisis, Maastricht, the Nixon shock, the Plaza Accord, and so on, something has truly shifted. So it is not just that these crises are now simultaneous, nor that they are following a number of previous shocks, starting with the crisis of 2008, after which came the pandemic, a war in Europe, the war next door in Kashmir, and so on. But while even from Cyprus we're watching the war unfold in our skies, I think that it is what's shifting under our feet that will be changing the world that we live in. First, nobody understands markets anymore. The international treasuries market is now 5 times bigger than it was in 2008. Non-bank players are increasingly more important now, managing 50% almost of all market assets. The initial drivers of the treasury sell-off since last April were not banking institutions, but they were asset managers, private investors, and hedge funds. That was a clear signal that something is changing. Such entities are now slowly dominating international markets as a whole. This is crucial as investment funds, private equity firms, and yes, fintech are increasingly replacing banks both in asset management and in credit creation. Decentralized finance is growing, and liquidity, risk, and contagion now move through less regulated, more opaque, and crucially less understood channels, which central banks are less equipped to monitor, stabilize, or rescue. This is not by itself necessarily bad. Even in Cyprus, non-bank financial institutions now manage assets worth approximately 50% of GDP, generating primary income from abroad. And more importantly, risk has been corralled away from the real economy and the banking sector. This allows more room for risk management, intermediation, and profit generation. But it also means that risk is slowly gathering in parts of the market which are not only less regulated, but are also less intimately understood by regulators and central banks. And with this comes the concern that at times of crisis, they don't truly understand how to intervene. The traditional solvency versus liquidity concerns that dominated decision-making in times of crisis is particularly difficult to nail down under conditions of under abnormal conditions, are now even more difficult to understand. Contagion is more nuanced, repercussions and the calculation of whether to bail out are less clear, and even questions of valuation are less understood. We are therefore less able to manage the next crisis, especially given that specific governments which led such responses in the past are now very, very likely to be part of the causes of the next crisis. It is important here to underline that economics and economists, as opposed to business, are not big fans of profit maximization and rapid growth. This is partly why startups and fintech make boring economists uneasy. The job of economics is to be boring, slow, and unexciting, the opposite of startups and fintech. Economists, they like gray suits and safe cars. They drive Volvos. They have 1.2 kids and 1.1 dogs. They hate emojis and they watch linear TV. This is precisely, perhaps, why we need economists now more than ever, but that is a topic for another day. But the job of economics is stability. Yes, growth and profit, but slow growth and steady profits. The economist's paradise is stable, slow, growing in margins, and remaining within one standard deviation of projections. A second foundational change that we need to look out for is the very havens of stability in the economy. Again, much is changing, and much is changing quickly and in ways we don't truly understand. Sovereign debt, especially US, American equity markets, and commodities like gold used to present a safe haven for turbulent times. Now US debt is loaded with volatility and political jamming. US equities are also more unpredictable. They entail unknown risks and very high PE ratios. Gold is being partially replaced by alternative hedges, including crypto. And China, a key engine of world growth, is slowly revealing the immensity of local government debt and its troubled demographics. Most importantly, American economic institutions could be relied upon to generate solutions, predictable policies, and to provide answers in times of crisis. Yes, these solutions were usually painful, often slow, and many times wrong, but they were there. And we knew that there was someone on the helm. The leading economic rescue team always came from the Fed and from the IMF, two institutions which are now under direct and immediate attack by the most consequential government in the world. Even though the US Supreme Court has provided at least partial protection for the independence of the Fed, we will have a new Fed chairman in the next 10 months. That decision will not only move markets, it will also define the game of the international economy for the next several years. At the same time, apart from appointing a new Fed chairman in less than a year, the American government has also signaled that its support for both the IMF and World Bank is now conditional on a number of issues. What this entails is that the void created by a dollar declining, not so much in value as much as it's in dominance, must be plugged in by the ECB, which is the only game in town to do so. The ECB cannot and will not plug the entire gap, but it needs to step in as a matter of obligation to both the European and the world economy. The decline of the dollar seems to be both inevitable and very, very slow. In the coming years, the trends seem to be firmly entrenched. The ECB should treat this not as an opportunity, but as an obligation, as it lacks neither the tools and capability nor the leadership to rise to the task. As the dollar declined from 72% to 58% of world reserves, the euro area must now focus on breaking through the 20% mark for the European currency. Although an exorbitant privilege will continue to exist, the euro should act as an additional non-antagonistic reserve for stability. The issuance of a digital euro will be a crucial point of flux for this development. It should be noted, by the way, that the landscape as described is the very reason why sovereign debt should continue to decline as fast as possible now and should remain low in the years immediately following 2025. This year, 59 countries, accounting for 82% of world GDP, have accelerated their deficits, even as bond markets are becoming less predictable. Especially for small open island economies whose sovereign debt is small, somewhat exotic, less known, and illiquid, the need to maintain ample fiscal space and access to markets to meet all predictable challenges is key. Such challenges include a true and meaningful digital transition, climate mitigation, green transition, social challenges, energy management, infrastructure development, and growth policy. But while declining debt levels should make some room for counter-cyclical fiscal management of accelerating spending needs, what I have just mentioned only includes the predictable needs. As multiple geopolitical, unpredictable challenges rise in a foggy, uncertain, and protean environment, unpredictable needs must also be served, and they can only be served if more fiscal space is maintained for counter-cyclical policy. So where does this leave us for today's discussions? Economic policy, currency management, and monetary policy are all clearly political decisions. Likewise, all economic crises are deeply, deeply political events. The world is in turmoil even as the markets, their structure, their behavior, and their technologies are redrafting the very rules of the game. Trade, FX, Fintech, and regulation are piled with risk, but also with opportunity. Non-banks are replacing traditional banking, not only in retail banking, but in investment banking as well. The failed attempt by the previous American administration to regulate hedge funds has stalled all efforts to regulate smartly without stifling profits, more than would be necessary, and to improve risk management. We should focus on growth, but steady, unspectacular growth, risk management, swift compliance, good governance, and a firm internal stance on AML policies should come to the fore. These will ultimately separate those who will decline from the survivors and those who will merely survive from those who will thrive. And yes, we should also focus on the political leadership, not only how we choose them, but how we educate them ahead of the next big, inevitable regulatory wave, which will be coming in the next few years. Now, I wish you all a fruitful conference, secure in the knowledge that these first few minutes of the conference will probably be the most boring of the next 2 days. So, thank you.